All right, so I've started the recording. So as I said to you, I'm doing some demonstration problem for the cash flow statement. That's the module 6, chapter number 13 in your book. And first we are doing problem number 13, 1A. And we're given a balance sheet and additional information. And at the bottom, you are required to do prepare a statement of cash flows using the indirect method of presenting cash flows or used for operating activities. Now, of course, we are in the last class when we talked about the statement of cash flows, there are two methods, direct and indirect. As more than 90% of the companies use the indirect method, we are learning to prepare the statement of cash flows using the indirect method. So that is how that's why we are picking up on that. Now let's start with the net income. Now usually net income will be given in an income statement if you are given one. If you are not given, then sometimes they may give you a retained earnings account, and there you'll find the net income. In this case, we are only given a balance sheet and additional information given here. Item number E, it says there was a 500,000 credit to retained earnings for net income. So that is the amount that I'm going to take, 500,000. Okay, so that is the first thing. Okay, now the next thing that we are going to look at is the adjustments. Remember, the adjustments are now you have to use this language verbatim, adjustments to reconcile net income to net cash flows from operating activities. And as I said to you in the last class, we will be adding back all non-cash expenses. Now, there is a non-cash expense of depreciation. It is given to you somewhere, that is, okay, investment, equipment, no disposal. Okay, then, all right. Okay, so as you can see here in the balance sheet, accumulated depreciation equipment has increased from 500,000 to 600,000. So that is the amount of depreciation. Accumulated depreciation will increase when you add more expenses. So that is from where we are getting that 100,000. So 100,000. Okay, so this one you are looking at the balance sheet. Please remember, we are looking at the balance sheet. Accumulated depreciation account. Okay, so that from where you got that, so 600,000 minus 500,000. Now, of course, since depreciation is to be added back, take it as a positive figure. Now, next one that you'll have to look at is any loss. So in the additional information, we are told investment were sold for 175,000 cash. That is one information. So let's check what was the value of the investment. Remember, here in the balance sheet, we are given the investment at 100,000, right? So we sold it for 175,000. So that would mean I made a gain of 75,000. So that is what I'm going to write here, gain on sale of investment. Now, since the gain is to be subtracted, I will put within parentheses. So that is 75,000. Okay, now remember that calculation is 175,000 sale value minus the book value of 100,000. Okay, so that's how I got that 75,000. And now, since we don't have any other things to be add or subtract, what we are going to do is we are looking at the changes in the current operating assets and liabilities. Now, remember, when we are looking at, we'll be looking at current assets except cash. And then on the current liabilities, we will be looking at everything except the dividends payable. So what we are going to do is we are going to look at accounts receivable. If you see the accounts receivable, it was 400,000 last year. Now it is 450,000. Now it has increased. So if it increases, that would mean you would have purchased the asset. So therefore you would have used the cash. So increase in accounts receivable will be taken as a minus 50,000. Okay, why we are taking minus 50,000? Again, I gave you a rule. The rule is increase in current liabilities and decrease in current assets will be added. And the other way is true. Increase in current assets and decrease in current liabilities will be deducted. So this is a deduction amount. So that's why I'm putting it in the minus figure. Now, next we are going to look at the inventory. Inventory, we see it was 750,000 in the first year. Now it is 770,000. So it has increased from 750 to 770. That would mean it has increased by 20,000. So that's what I will increase in inventories. Again, a negative amount. Okay, so that is how I got that 20,000. So if you want to write down how I got that 50,000, accounts receivable was 450,000 minus 400,000, and the inventory was 770,000 minus 750,000. All right, so that would be the increase in inventory. Now we have taken care of the current assets. So we move on to the liability side. On the liability side, I have accounts payable. Accounts payable is 300,000 and 340,000. So it has increased. Now liability increase will be added. So therefore, what I'll do is I'll say increase in accounts payable, and the amount is 40,000. I will be taking as a positive figure. Remember that, because it is an increase in liability. So that would be how much? 340,000 minus 300,000. Okay. So there was a difference of 40,000, and that is taken as a positive figure. Remember again the rule that any increase in current liabilities will be added, decrease in current asset will be added, but increase in current assets and decrease in current liabilities will be deducted. So now we look for another one, that is the accrued expense payable. Accrued expenses are from 40, it was 50,000 and 45,000. So that means it has decreased. So therefore we will take these as decrease in accrued expense payable, and the amount is going to be, of course, minus 5,000. Why? Because this is a decrease in current liability, and the decrease was, of course, 50,000 minus 45,000. All right, so that would be how we'll handle that part of cash flow from operating activities. Now what we can do is we go here and then sum it up. So I will sum all these numbers and get 490,000. So that is, now you can see this is a net cash flow from operating activities of 490,000. How did I get that? Of course, this is a positive number, this is a positive number, and this is a positive number. I add all the positive numbers and deduct all the negative numbers, so we'll be getting 490,000. If you are using Excel, what you can do is you can use a sum function and just include all the cells, because we have already put the negative numbers in parentheses, so Excel will recognize, even if you're summing, it will recognize that is a deduction. All right, so that will be how we'll do the operating part of the section. Now, what we do is we go on to the investing part of the section. Remember, in the last class, I had told you that we'll be looking at the long-term assets. Long-term assets while looking at the investments in land, property, building, or any other intangibles that has increased or decreased. General theme is if they have decreased, that means I have sold them, and that is the inflow, it will be positive. If I purchased them, then I would have used cash, so that is a negative figure. So we already know we sold the investment, so that's why let's start with that. First one is cash received from sale of investment, and the amount was 175,000. Because it is cash received, I'll be taking that as a positive number. So that's why I will have 175,000. Now, next is, of course, we are told that number B, equipment and land were acquired for cash. So if they were acquired for cash, then what we'll do is we will understand that we have purchased the land and equipment. So let us first start with cash paid for purchase of land, and then cash paid for purchase of equipment. So how much of land did I purchase? Now, since another item we are given is that there were no disposal of equipment during the year, so that means we have only purchased them. So let's look at the land. Land was 0 last year, and now it is 500,000. So that means I would have purchased 500,000 worth of land. So that is an outflow because I'm using cash. So I'll put it within parentheses. So that will be 500,000. All right. Now, next is the cash paid for purchase of equipment. That would be again 1,200,000 was last year, and this year it is 1,400,000. So we have purchased another 200,000 of equipment. So that is what we'll do. We'll take minus 200,000. Now, of course, this one was given, right, given in A. And this was, of course, in the balance sheet, we took the difference that was 500,000 minus 0. And this was, of course, 1,400,000 minus 1,200,000. Okay, so that's how I got that. Now I'm done with the investing because there are only three assets, and we have taken care of the changes in those 3 long-term assets. So let's just sum it up and then calculate what was the change. So if I use the sum function and select the 3 numbers, I get 525,000 negative. So as you can see here, I have used the term net cash flow used rather than net cash flow from. So whenever you have that negative, that's what you are expected to use. Okay, so that is 525,000 negatives, because these were two negatives and one was positive. Net amount was 525,000. So now what we do is we move on to the financing activities. On the financing activities, in the last class I mentioned to you, there are three things you're looking for financing activities. That is, if you have borrowed money, so that would be on the long-term liability, or if you have issued any common stock or preferred stock, that will be again on the liability side. And then if there is any payment of dividend, mm, mm, cash dividend, of course. So here somewhere we were given that there was a 90,000 debit to retain earnings for cash dividends declared. So that means I have a dividend payment. So let me start with that. That would be cash paid for dividend. So again, that will be minus 90,000, because it's a payment. So, and it is given, so we don't have to worry about that. Next thing that we are going to look at is there is a change in common stock. Okay, so common stock amount, sorry, there was a dividend payable, so that amount has to be adjusted. Okay, so that is not 90,000. I have to adjust because there was a dividend payable. If you look at the balance sheet, dividend payable was 30,000 and 25,000. So I paid 5,000 out of that total 90,000. So that would mean it would be, because this is a debit for retained earnings of cash dividend, out of that 5,000 is for the previous. So therefore, what I will do here is dividend declared is 90,000 minus 5,000 will be, of course, minus 85,000. Okay, in the last class, if you were there, I also showed you how you can calculate that amount by opening a dividend payable account. So when you have a dividend payable account, so what you can do is start with a dividend payable last year on the credit side, and then when there is a declaration of dividend, what we'll do is we'll put it on the credit side, 90,000. So 90,000 plus 25 will be 115,000. And on the debit side, it is 30,000. So therefore, you'll get a net amount of 85,000. So that's another way of doing it. So here, direct way is, since the dividend payable has increased, that means I did not pay that 5,000 which I declared. So 90,000 was the amount that was declared. Out of that, 5,000 I have not paid because my dividend payable has increased. So therefore, it is only going to be 85,000. Next thing we're looking at is the common stock. Common stock has increased from 600 to 700. So that is 100,000. And along with that common stock, I got some excess money. So here that's a common stock, 175 to 200. So that is another 25,000. So what I will do is I will do 100,000 for common stock plus excess paid in capital is 25,000. So that would be, of course, positive 125,000. So that would mean your cash received from sale of common stock is 125. Now I can do a sum. So this will be summation of these two. One is positive and one is negative. So that will give you a positive of 40,000. Now we have completed all the three activities. So what we'll do is we will add these three. So this will be okay. So the net change, increase or decrease in cash is 5,000. So of course, if you're using Excel and if you have already put a number in negative, it will subtract automatically even if you use the add function. So here I'm adding 495 minus 525 plus 40,000 will be 5,000. So we got 5,000. Now we know that in our balance sheet, we were given beginning cash balance of 150,000. So I put that 150,000 here. So from where did I bring? I brought that from the balance sheet. Now, once I bring that from the balance sheet, I add only these two amounts. Okay, so that will be 155,000. Now, the way you check that answer is the ending balance of cash 155,000 in the balance sheet? If it is, then that means you have done your statement of cash flows accurately. So that is how we do that problem number 13.1a. Now I'm going to move on to the next problem, that is problem number 13.2a. Okay, so we're looking at problem 13.2a. We can just read the problem, the comparative balance sheets. Again, here in this case, we are given the comparative balance sheets. Okay, did I increase too much? Okay. All right, the comparative balance sheet of Yellow Dog Enterprises, I think I increased a little bit. Okay, I think now we're good. All right, the comparative balance sheet of Yellow Dog Enterprise Incorporated, December 31st, Y8 and Y7 is as follows. So this figure is for Y7 and this figure is for Y8. Now, again, remember the concept that we are going to use is, of course, let me go to the format for that one. Okay. So this is the format I'm going to use for Yellow Dog Enterprises. All right. Again, same concept that we're going to use. We are going to first start with the net income. Now, there are two ways of giving the net income. Either they give you an income statement or they give you information. So here we are given number A item. It says net income of 250,000. So that's what we are going to start with. So that would be 250,000. Okay, so if we are given the retained earnings, of course, we'll be looking at the credit side of the retained earnings in order to find what is the net income. Here we are given directly the net income, so we're good with that. Okay, so now what we do is we move on to the next item, that is going to be any depreciation or not. So I think we are given a depreciation. We are given a depreciation of number B. It says depreciation reported on the income statement was 135,000. So that is what we are going to put here, 135,000. That's the second thing. Now, with regards to the changes in the operating assets and liabilities, we're going to look at the current assets and current liabilities, except cash. So we have accounts receivable, inventory, prepaid expenses, 3 current assets. Then in the current liabilities, I have only 1, that is accounts payable. So these are the 4 current assets and 3 current assets and 1 current liability. So we're going to look at the change. Remember again the rule. Rule is decrease in current assets is added and increase in current liabilities is subtracted. So other way, and other way around is any increase in current asset is subtracted and decrease in current liabilities is added. So let us see what has happened to your current assets and current liabilities. Let's start with the accounts receivable. Accounts receivable was 280,000 and 260,000. So it has decreased. So that is a current asset, and a decrease in current asset, of course, decrease in current asset would be positive 20,000. Okay, so that is number one. Number two is inventory. Inventory, you can see it is 450,000 and 520,000. So that would mean it has increased. So that will be negative amount, increase in inventory. And the amount is going to be 520 minus 450 will be 70,000. So again, that will be minus. So I'm going to put minus 70,000. How did I get that? The inventories has increased from 450 to 520. The difference is 70,000. Okay, continuing with the other current asset, that is prepaid expenses. So prepaid expenses we can see also has increased. So that's going to be minus. And the increase was from 5,000 to 15,000. So therefore, that will be minus 10,000. And of course, we are going to write increase in prepaid expenses. Now let's move on to accounts payable. We have finished the current assets. We're going to do the current liabilities. Current liabilities has increased. So we'll say increase in accounts payable. Now remember, increase in accounts payable is a positive amount. So that would be 25,000. Okay, so decrease in accounts receivable is added. Increase in accounts payable is also added because they are opposite spectrums, decrease and increase. And then if there is any increase in current asset will be subtracted. Decrease in current liability would be subtracted also, but we did not have a decrease in current liability, so we don't have that information here. Now what we are going to do is we are going to sum these up. So if I sum up all these, I get 350,000. So that is the net cash from operating activities. All right, now once I have done this part, now I'm going to move on the investing activities part. In case of investing activities, we will be looking at the long-term assets. Now, there is only one long-term asset. So is there anything that's given here? It says, okay, it says equipment was purchased at a cost of 420,000 and fully depreciated. Investing costing 90,000 was discarded with no salvage value realized. So we are given that information directly. So let's see, let's check whether it checks out or not. We can see that your equipment, let's see, equipment has increased from 800,000 to 1,130,000. So that would mean, let's take that and see it, 1,130,000. And then last year it was 800,000. So let's take the difference. It was 330,000, increase in 330,000 before the sale. And I sold 90,000. So that would mean 90,000 will give me 330 plus 90 will be 420. So it checks out. So that means it is very safe that we can take this directly. That is cash paid for purchase of equipment and it is a negative amount, right? Because that is 420,000 purchase. So I'm going to say 420,000 negative. And now, since that is the only cash flow from investing activities, the net cash flows used for investing is also 420,000 negative. All right, so that is what you call taken care of. Now what we are going to do is we're going to go on to the financing activity. Now in the financing activity, remember, we are going to look at the long-term liabilities and any changes in the common stock as well as any okay, so is it says 30,000 shares of common stock were issued for 20 cash. Okay. All right. So that would mean, let's check that out. 200 to 500,000 is 300,000. So that is good. And then is 100,000 to 400,000 is another 300,000. So 300,000 plus 300,000 is 600,000. And if you do 30,000 times 20, that will be 600,000. So we are good. So what we'll do is we will say cash received from sale of common stock. Remember, it was 30,000 times 20. Okay, so that will be 600,000. And it is going to be positive because I'm getting money. Next is mortgage note payable. Mortgage note payable was 500,000 and now it is 0. So that means I would have paid off that mortgage. So therefore, what I will do is I will say cash paid for to retire the mortgage note payable. That is going to be minus 500,000. And the next thing that I said we'll be always looking out is for cash dividend. It says cash dividend declared and paid 545,000. So we are good with that. We are told it is declared and paid. So we are interested in the paid amount. And since it is 45,000, I'll take it as minus. Again, this is positive and the two of them are negative because this is cash received, this is cash paid. Okay, so let's do the summation. That is 55,000. So net cash flow from financing activity is 55,000. Now, after we have done that, what we'll do is we will add these up. So let's add this figure here plus this one and plus this one. That would mean net cash increase or decrease in cash will be operating activities, investing, and financing. Now we got a negative 15,000. That would mean the net decrease in cash is 15,000. Now what we do is we go up to the balance sheet and check cash is 110,000 in the opening. So previous year we started with 110,000. And during the year there was a change of 15,000. We got 95,000 as the ending balance. And if you check the balance sheet, we did get 95,000. So now that means we are good with that calculation. So that is your 13.2a. Now I'm going to go on to do 13.3a. All right, now in 13.3a, it is slightly different from how it is the rest of the information was given to you in 2 and 3. So that's why we'll look it slightly differently in this. Okay, now in this case, what we are given is we are given a comparative balance sheet, 2 years, and then we are given accounts. see here in land account, building account, and then accumulated depreciation account, equipment account, accumulated depreciation, equipment account, bonds payable account, and all that accounts are given to you. Then common stock account, paid in capital excess account, and then retained earnings account. That is all, prepared statement. So in this case, what we are given is we are given the account. So what we have to do is we have to figure out the information that is from where you are going to get the net income. Remember, as I said to you, net income will be either given in the income statement or in the retained earnings statement. So here we have a retained earnings statement as one of the items given to us. So you can check here, there is a net loss of 35,320. So if you are given net loss, you will be putting it as a minus figure. So that will be minus 35,320. So that information is taken care of first. Second, what we have to do is we have to look for depreciation. And since we are not given the income statement, what we'll have to do is we'll have to check the accumulated depreciation balances. So let's move up and see here. There is one depreciation, that is depreciation for the year 29,340. So out here, I'm going to just use this area here, that is 29,340 is one depreciation, that is for equipment. Okay, we're going to look up and see if there is anything here. There is a depreciation for building, 26,280. So I'm going to add that 26,280 to that figure. Now, is there another accumulated depreciation? I guess not, because land is not depreciated, so we are good. So what we do is we add these two and get 29,340 plus 26,280 would give you 55,620. All right, so that is taken care of. Now, again, remember, what you have to do is you have to check the accumulated depreciation accounts to find the depreciation for the year. If the account is not given, you can take the balance sheet figures here. But if the account is given, you have to look at the accounts. Now, next, what we are going to do is we are going to see if there was any loss or gain on sale of any asset. Now, we can see that we have sold land. You can see land costing 163,800 was sold, and it says realized 151,200 cash. So that means we made a loss on sale of the land. So how much is the loss? Now, loss, of course, is going to be added back. So let's just look at that. That will be 163,800 minus 151,200. So the loss is 12,600. So if you want to write it down here, loss is, of course, 163,800 minus 151,200. So what does it mean? It means there was a land costing 163,800, but I sold it for 151,200. Therefore, that is a loss, and I'm going to add it back to the net income to calculate cash from operating activities. Now we are done with the loss and gain. Now what we are going to do is we are going to look at the changes in the current assets and current liabilities. Let's see. First, accounts receivable, inventories, prepaid expenses, and then I have accounts payable. So I have 4 items to look at. Accounts receivable, let's see. Last year it was 761,940. Now it is 828,900. So there is an increase in accounts receivable, and increase in current asset is a negative item. So let's see how much is the item. So that will be, okay, I'm going to write it here. So that is going to be 828,900, then minus 761,940. Okay, so what I will do is I will take this. Okay, so let's see. Okay, I have to get a minus sign. I have to put a minus sign. So 2 ways of doing it: either put a minus sign or start with a smaller amount to get a minus sign. Let's try doing that. So start with 761,940 minus 828,900. That will be minus 66,960. Now remember, the concept is if there is an increase in current asset, it has to be shown as a negative. The logic is same. Take the difference and put it as a minus sign. So that is the first one. The second one is the inventories. Inventories also have increased. So they have increased. Let's write here increase in inventories, and the amount will be, again, because it is an increase, I have to get a negative figure. Okay, so that will be 116,290 minus 126,800. Okay, so that is, it should be minus. So that's why we'll take that minus figure. It should be, okay, why I'm getting this one? Oh, okay. All right. So in order to get a minus, I have to do this will be equal to 116,290 minus 126,800 will give me a minus of 105,480. Now, of course, I took the difference between the two, 1,268,460 minus 1,162,980. But of course, since I have to get a negative item, I have to put a minus sign here. Okay. Now, next thing we are looking at is prepaid expenses, and as you can see, it has decreased. So if it is a decrease, it is a positive amount. So prepaid expenses is an asset, decrease is a positive amount. So what is the amount that I will be getting? That will be 5,760. Of course, the concept is same. We will subtract 35,100 minus 29,340. So the difference between the higher amount and the lower amount, but the what you call signs will depend on the concept. Increase in current asset minus, decrease in current asset plus, increase in current liabilities plus, decrease in current liabilities minus. So now we have finished with the current assets. So let's go on to current liability. There is only one. So there is a increased or decreased, as you can see. It has decreased from 958,320 to 922,500. So let me take that decrease in accounts payable. And since I want to have a minus figure, I'm going to start with the lower figure. That is going to be 922,500 minus 958,320. Okay, I got a minus figure, but of course, what I was doing was I was taking the difference between the two, 958, 320 minus 922, 500. All right, so that is how I will handle that part. Now, what I can do is do a sum of all these numbers and get the change. So that will be, okay, 169,540. All right, so let's check our numbers. First is net loss was 35,320 and depreciation was 55,620. Loss on sale was 12,600. Increase in accounts receivable was 66,960. That's a minus amount. 105,000. Okay, that doesn't look good. Okay, let's see. This was increase in inventory. Increase in inventory was 1,268,460. I think I missed that 60 here. Yes. Okay, now I think I'm good. 105, 480, 5760, and 35, 820, and 169, 600. Okay, now that is the cash from operating activities. All right, so, okay, I was looking at that. 169, 600. Okay, good. All right, so that is what we were supposed to get from operating activities. Now, what we are going to do is we are going to look at the investing activities. Now, for investing activities, since we are given the account balances, so what we are going to look at is we are looking at the equipment. So let's look at the equipment. Okay. And sorry, this was the, not the other one. We have land, we have building, and we have equipment. In fact, we have three assets to be looking at. So here we have land. Now we already know we sold a land and received 151,200. So let's take that. This is cash received from land sold. That is a positive amount, 151,200. Okay, land is taken care of. Now we see a building. Now in the building case, we are given acquired for cash. Acquired means purchase. So cash paid for acquisition of building, and it has to be taken as negative figure 561 600. Okay, that will be taken care of. Now we've taken care of building. Yeah, that's it. Then next is equipment. Equipment, it says purchased for cash. Of course, there was 104,400. So we'll say cash paid for purchase of equipment. Again, this is minus amount. When the accounts are given, it is easier because we don't have to do the calculation. We just look at the accounts and figure out. Okay, so that is all that we have because there are only three assets. So We'll sum these up. Okay, so that is 514,800 cash flows from investing activities. Now it is used. So of course, this company hasn't been doing great because it has a negative operating activities, and it has, of course, usually investing activities are normally negative. But cash flows from financing activities, we are going to look at two things. That is the change in the liability and owner's equity. Liability, I have a bonds payable 0 to 270. So that means I have issued bonds payable. So cash received from issue of bonds payable. Let's see in the bonds payable account. Yes, it is 270,000. So we have issued 270,000 worth of bonds payable. That is taken care of. Now, I'm taking that as positive because I'm receiving cash whenever I'm issuing the bonds. Okay, so common stock is 25 at par, and we have issued 8,000 shares of common stock for 50. So that would mean we have issued them at a higher price. So 25 was par. That is why you can see this 200,000 here and 200,000 here. So that would be make it 400,000. So cash received from issuance of common stock. Of course, we are also given that we issued 8,000 common stock at the rate of 50. So that is how we get that 400,000, or we are given directly in the accounts common stock increased by 200,000, common stock excess par value increased by 200. So that is 400,000. All right, now we go on to the retained earnings and see if there is any cash dividend. We can see there is a cash dividend of 32,000. So what I will do is I will say cash paid for dividend. Now this is going to be minus figure, 32,400. Okay, 32,400 will be minus figure because that's a payment. Now I'm done with my financing activity. So let's do a summation. Okay. All right. Now, as you can see, we have borrowed money, but we have used that money to buy some property. So that is a good sign. Only thing bad sign here for this company is that the cash from operating activities are negative, and which is not a good sign because we want to generate positive cash flows from operating activities to remain healthy. So in one, I think in the PVL activities, you are supposed to comment on those. So please learn to comment on that. That is, if there is an increase in the financing activities, then that should have been used for investing activities. But if they are used, if you're borrowing to pay off another loan, then that is not good sign. So here we are doing pretty fine, it looks like, except the operation part. Sum, of course, I will do the summation of these three activities and get a net amount of minus 46,800. Now what we can do is we can go up and look at the balance sheet. Here, balance sheet previous beginning of the year was 964,800. So if I add these two, I should get the same figure, which is the balance in this year. And I think we got 918,000. So we have calculated the figures accurately. All right, so that is how you will do this problem. Now I have another small segment to be completed on the statement of cash flows. So let me go back to my PowerPoint slides for a moment, and then I will stop sharing this one. Now let me bring up the PowerPoint slides. Okay, we just did the problem. Now, as I said to you, please try these three problems next and bring them next class. Now, this is not a homework. Homework is on Blackboard already, which is very similar to the 13.3a problem I just did. Go back and try that today so that you don't forget the concept that we discussed. And please make sure that you try these and bring it to the next class. Next is Zoom. So I will be asking you as to what are the figures that you got, and we'll be checking on that. All right, so now the last segment in your cash flow statement is analysis for decision making. Number one is the free cash flows. So free cash flows is a measure of looking at how much company has a discretionary amount of cash to use for expansion or any other activities that they want. So how do you measure it is that's the amount of money that is left after paying for any purchase of property, plant, and equipment. Like in the previous case, we had negative operating cash flows. So that means they did not have any free cash flows. So that was not a good situation. So since the investment in property, plant, and equipment necessary to maintain current operations cannot be often determined from financial statement, we use this ratio. So how do you calculate the cash flows from free cash flows? That will be net cash flows from operating activities minus cash used to purchase property, plant, and equipment. So any purchase that will be available from the cash flow statement in the investing. In the previous case, we purchased, remember, two things, that was building and equipment, but we did not have a positive cash flow, so that was not, there was no free cash flows. Another is, of course, the free cash flow can also be expressed as a percentage of sales in order to provide a measure that can be computed over time, or just compare with other companies. The ratio is free cash flow, that is this amount that we have calculated, divided by your sales revenue. So positive free cash flow is considered favorable. A company that has free cash flows is able to fund growth and acquisition, retire debt, purchase treasury stock, and pay dividends. A company with no free cash flow may have limited financial flexibility. So that will be leading to liquidity problems in the future for that particular company. Okay, so if you take example information from the annual reports of National Beverage Corporation for 3 years is as follows: year 3, year 2, and year 1. We are given net cash flows from operating activities from their cash flow statement. And from the cash flow statement, we also found that they purchased property, plant, and equipment 13,333 in 1,031,974, 14,015,000, and then the sales were given these figures. Then what we can do is we can calculate the free cash flow by using the formula that is going to be, of course, the cash flows from operating activities first line, that is 139,442, 154,721, and minus cash used, this one, the second line, free cash flow. So as you can see, year 2 was better because it has a higher level of free cash flows as compared to year 1 and year 3. All right, so that would be how we'll handle the free cash flow calculation. Now, I said we could also do the what you call ratio of free cash flows to sales. And if you look at the ratio also, again, the free cash flows divided by sales. So that would be free cash flow is, of course, we just calculated these amounts divided by these amounts here, sales would give you a percentage. And we see that percentage 10%, 12.6, and 12.1%. Definitely year two was better. We already know that. But this percentage will give you a better situation if you want to compare a different sized what you call company with that. So that is how we handle that situation. So in summary, we talked about the cash flows activities reported on statement of cash flows, and then we prepared the cash flows using the indirect method. And then we also learned the cash flows used for investing, financing activities. We prepared a statement of cash flows, and we also learned how to. So these two appendixes I'm not covering for your class. So with that, I come to an end of the class period for today. So let me stop recording. Okay. All right, I'm stopping the recording, and I'll be putting up this recording on Blackboard for your review at your convenience later on.